Even Warren Buffett, one of the greatest investors in history, has made mistakes worth billions of dollars. And that is exactly why every investor must study them. Make sure you subscribe to the channel so we can reach 1000 subscribers. Thank you very much. Because if Buffett made mistakes even after decades of discipline, imagine what happened when normal investor invest with ego, excitement, and no process. Most people look at Buffett and only see Coca Cola, Apple, GEICO, American Express, and Berkshire Hathaway. But the real Buffett is not built only by success. The real Buffett is built on mistakes, losses, missed opportunities, and painful lessons. And this is where the real story starts. Buffett once admitted that buying Berkshire Hathaway itself was one of his biggest mistakes. Today, Berkshire is a giant company, but originally it was a struggling textile business. Buffett bought it because it looked cheap. The assets were there. The stock price looked attractive, but the business was weak. Textile manufacturing in USA was losing competitiveness. Margins were poor, capital needs were high, returns were low. This taught Buffett one of the most powerful lessons in investing. A cheap stock can still be a bad investment if the business itself is dying. Most investors completely miss this. They see a stock down by 50% and think it is cheap. But cheap compared to what? If profit are falling, debt is rising, and the industry is getting weaker, then the fall may be justified. Buffett later understood that buying a great business at a fair price is often better than buying a poor business at a cheap price. But here is the shocking part. Buffett also missed some massive opportunities. He avoided Amazon for years because he underestimated how powerful Jeff Bezos was building the business. He also did not buy Google early, even though Berkshire's own company were using Google advertising and could see the strength of the business model. This does not mean Buffett was careless. It means even the best investor can miss opportunities outside the circle of competence. And this changes everything. In investing, your goal is not to catch every winning stock. Your goal is to avoid permanent damage. Missing Amazon hurts emotionally, but buying a bad company with borrowed money can destroy you financially. Buffett's Dexter shoe mistake is another powerful example. Berkshire bought Dexter shoe in 1993 and Buffett paid using Berkshire stock. That decision became extremely costly because Dexter later struggled badly due to low cost foreign competition. The business value collapsed, but the Berkshire shares given away became worth billions over time. This mistake teaches a brutal lesson. When you use a high quality asset to buy a weak business, the real cost can become much bigger than the original price. Indian investors should understand this very clearly. Sometimes we sell a strong long term compounder to buy a hot stock just because it looks exciting. Later, the hot stock falls and the compounder keep rising. That emotional mistake can silently damage wealth for years. Buffett also made mistake in airlines. For many years, he avoided airlines because the industry had fixed cost, heavy competition, fuel risk, and weak pricing power. Later, Berkshire invested in major US airlines, but during the COVID crisis, Buffett exited the position. Whether investors agree or disagree with that, the lesson is simple. Some industries can look attractive in good times but extremely fragile in bad times. High debt plus low pricing power plus sudden demand shock can become a dangerous very fast. This is why investor must not only ask how much can I make, they must also ask what can go wrong. That one question can save years of wealth. Buffett's mistake proved that investing is not about only being perfect. It is about having the humility to accept errors quickly, the discipline to avoid repeating them, and the patience to stay within your strength. The key lesson is very simple. Do not worship any investor blindly. Learn the process behind their success and the pain behind their mistakes. A realistic investor know that losses will come, miss opportunity will happen, and mistakes are the part of the game. But discipline decides whether one mistake became a lesson or a disaster. So before buying any stock, ask three questions. Do I understand the business? Can it survive bad times? And am I buying because of logic or emotion? If this video help you to think clearly, like the video, subscribe to the channel and comment your opinion. Thank you very much. See you in the next video. Bye bye.